What's up, everyone, and welcome to the Daily Macro Update for Monday, December 8th. Not too much on the macro data front. Really, we're waiting for the Fed meeting on Wednesday at 2:30 p.m. Eastern Time is when the actual Fed meeting press conference begins. We're going to be going live for the press conference as well as live market reaction starting at 2:15 p.m. Eastern Time. So that's 15 minutes before the press conference actually begins. So if you guys want to subscribe to the YouTube channel to see that in its entirety, then consider subscribing to the channel. And yeah, we're looking forward to going through all that data when it comes out there. But taking a look at some of the macro data for today, we just got inflation expectations from the New York Fed, which remained relatively steady, although we are getting some signal from the bond market that see this low volume time in order to take some profits ahead of the Fed meeting on things that continuously are at the top end of the trading range on lower volume there. So that's what we continue to see. But yeah, taking a look at this, it remains unchanged from October and well above the 2% target there. So that's what we're seeing here in terms of the inflation expectations. When it comes to the Fed rate decision probabilities, according to the futures market here, we can see that it's nearly a 90% chance of a 25 basis point cut. So the Fed is going to cut rates into inflation accelerating or remaining sticky, as well as growth accelerating. From that viewpoint, there's really no reason to cut rates right here, especially, because we talked about this last night in the Sunday macro wrap up, where yes, the labor market is getting worse, but it's in the context of the entire labor market supply also declining. So the equilibrium point between supply and demand for the labor market continues to fall downward. And so it's making a very unusual case in order to cut rates. Nominally, just looking at the numbers, yes, there is a case to be made for cutting rates, but at the same time, there's a huge risk to inflation reaccelerating here. So, but we can't control the outcome of this. All we can do is strategically position ourselves in order to take advantage of it so that we can protect our money. But when taking a look at the S&P 500 ETF SPY, looking at the ranges for today, we can see that it had a little bit of a correction here, nearly 50 basis points, nothing too crazy. But when looking at the volume, pretty dramatic drop off in volume here. I mean, really the last time that volume was this low, man, let's see. It's been a long time. All the way back in May. So, the market is about to close here in about 10 minutes. This was a extremely low volume day. And what's going to matter is obviously the catalyst on Wednesday. That's the Fed meeting. But really what we can see is that this has been a great time to continuously take profits, near now that the S&P 500 is still remaining near the top end of the trading range, even though it's getting close to the middle here. But we were talking about last night how what would create a great buying opportunity is if we did have a correction in the SPY down to the low of the trading range on a continued lower volume here, as well as taking a look at other positively correlated assets that are also near the low of the trading range to see what opportunities are out there. But yeah, we'll remain patient for a larger drop here, which I think might be coming this week with the catalyst on Wednesday. But what's interesting is that we are starting to see a shift in the macro. And I'll go through a couple of the main indicators here. But with the immediate term not chasing this bounce here, what's interesting is that we have the combination, and we've talked about this beforehand, but we have the combination of the dollar breaking its bullish trend. So the dollar is now neutral from bullish. At the same time, you're seeing a large acceleration. So in taking a look at something like the 10-year U.S. government bond yield, we're seeing that this is the highest point that it's been since late September, right? So September 25th was the last time that rates were this high. And so what's interesting is that, taking a look at when the Fed started cutting rates back at the September meeting, rates are actually up by about 14 basis points, flat to up. And so, this is similar to last year where they started cutting rates in September and the bond market rejected that by hiking rates. So it is interesting to see the bond market not participate with the Fed here. And this is really the main thing that people need to pay attention to, not so much that the Fed is actually cutting rates. Because if the Fed's, or if the 10-year bond yield starts to continue to accelerate here and goes to bullish trend, that's going to be a real big problem for the Fed. And so what the bond market is essentially saying is the Fed shouldn't be cutting right now. And, because of that, we're seeing the bond market start to price in a higher 5-year break-even inflation rate, now at 2.4%, which really has not changed in the last year. And so even though you're not seeing an acceleration in inflation, we are seeing it still remain persistently high, well above the Fed's 2% target. And so what's interesting is that the Bureau of Labor Statistics announced earlier this morning that they're not going to release any of the October data, so we're not going to be getting that. But we should be getting the November data here at some point. But yeah, we'll see what happens. Typically, the inflation data doesn't come out until the second week of the month, which maybe we'll see that come out next week. I know that if we take a look at, let's go to the Forex Factory calendar. If we go to next week, we can see that it has the CPI data coming out on Thursday, December 18th, which is after the Fed meeting. So we'll see what happens with that inflation rate. Really, what's going to be pricing, or what is being priced in right now, is still an inflation rate remaining around 3% for core CPI. And then for core PCE at 2.9%. So it's not really pricing in inflation coming down. And if the Fed is going to cut rates into that, it's no wonder why bond yields are actually going up. And so ultimately, this is continuously showing that that we are still in this no landing stop go cycle. And I'm going to continue to bring up this chart here until people have a good imprint of it in their mind, because with the higher inflation expectations, that is typically a good sell some signal, right? Now that's in the immediate term, but with inflation and growth expectations going higher, that could be more bullish for assets that are starting to gain a little bit of strength. Things like Bitcoin, which as we've seen over the past week or so, has been having a bit of a bounce. It still remains in bearish trend, excuse me, and volume has definitely dropped off a lot. So this is something that, you're not, or our team isn't buying right now, but if we continue to get a further bounce where Bitcoin is able to break through around that 96K, to 98K mark, more closer to 100, then that would be a confirmation of this next trend shift. So we're right on the verge of that. We still need to see the market continue to confirm that, but that is what we were looking for. And we're really getting early signs from the bond market, right? So if we take a look at the yield curve phase signal, Here's the yield curve here. Right now it's at 0.6 or 0.59 basis points. Over the past, when you look at the 1 week performance, 1 month performance, and 3 month performance, those are doing what's called a bear steepening, which a bear steepening happens when the long end of the curve, or the 10-year bond yield, rises faster than the short end of the curve, or the 2-year bond yield. And that's typically a sign of recovery, or either growth or inflation, or both at the same time having an acceleration, which we're obviously seeing better growth data as we saw services PMI come out last week having a large acceleration into expansionary territory, as well as we're seeing the inflation expectation rise back to 2.4% for the 5-year break even. And so it's not surprising that the yield curve is doing this, and that things that are, sensitive to this type of thing, like Bitcoin, are starting to gain some strength. So that is the big shift that's happening right now. That could be temporarily bullish for select amounts of risk on assets. But at some point, and this is the main thing that I want to be looking for in terms of the Fed meeting on Wednesday, is the summary of economic projections as well as the dot plot. Because if we see more dissents from the FOMC, meaning the voters on the Fed committee, then that could provide more context of the forward guidance of, potentially not cutting rates further, or going back into a pause phase with rate cuts. Which, if that's the case, then we will be going back to a more stop type of signal, which is when you might get a little bit of a correction in the markets at that point. And during that correction, you're going to be trying to look for, different bullish assets that are holding trend and at the low end of the trading range. So it's kind of like a filter system. So when everything is having a correction, which ones are holding up the best? Right? Those are the ones that you want to buy. So that's really what we're seeing today. Looking for buying opportunities in Google and Apple. Broadcom continuing to make new highs. Microsoft remains in bearish trend, but is having a bit of a bounce here. Same thing with Nvidia, but Nvidia remains neutral. So yeah, it's kind of like more of a risk-on type of day. You have things like healthcare having a bit of a correction on lower volume, but it still remains, one of the most bullish assets, one of the most bullish trending assets. And so it's still early. It's still too early to tell if this is a full-blown shift to risk-off mode, but we are seeing some early signs that could be the case. Again, we still need to see some follow through, but the main signal is to raise some cash heading into the Fed meeting. So, but yeah, that's all I'm seeing in the markets here today. Really not too much, because there's not that much news out there, as well as there's not too much of a change here today. I was buying a little bit of healthcare, but not much, because I'm waiting to see if we're getting a little bit more of a confirmation in this more, inflationary, higher growth environment. But it is giving me confidence that we continue to see bearishness in volatility. Even though volatility the VIX is having a little bit of a pop here today. Wouldn't it be surprising if you did see, maybe a further acceleration of the VIX, maybe into the 17 or 18, in which case that would be a great time to look for things to buy. But I'd rather do all that as the S&P 500 is near the low end of the trading range as well. So just not seeing that right now, remaining patient, and not falling for this bearish divergence that we're clearly seeing in the S&P. So with that, we'll go ahead and get into some questions here. Appreciate everyone for joining. Let's see. Aren't we due for a market crash based on the yield curve? No. If you're referring to the yield curve inversion that we saw, a couple of years ago, I think a lot of that was distorted by the massive amount of stimulus that was being injected into the markets. So yeah, I mean, the yield curve, it's still a useful signal, but in terms of the traditional way that it's, how inversions have been leading indicators, I think it's just been extremely delayed. So extremely delayed because of the massive amount of stimulus. All right, let's take a look at some of the questions here on TikTok. Aren't bond yields inverse from rate cuts? If you're meaning rising bond yields are inverse from rate cuts, yes, you're correct. But yeah, I mean, you have to remember that the long end of the yield curve is not controlled by Fed policy or the government. That's a free market. And yeah, if bond yields on the long end of the curve, which if you want to go to the extremely long end, let's take a look at the 30-year bond yield. That's clearly in a bullish trend now. And so if yields continue higher, lots of rate sensitive assets like gold, healthcare, things like that, that could be a problem. In which case you would want to own things that go up in a more of a higher growth, higher inflationary type of environment. But as you can see, the Fed has a real big problem. Because now they're forced to choose between, do we cut interest rates because we have a systemic supply problem with the labor market, which how would cutting rates even, solve the supply issue? It wouldn't. So we either do the only thing we know how to do, which is to cut rates, which doesn't solve the problem that we're, cutting rates for in the first place. And we also then risk inflation, and the bond market is clearly saying don't cut rates, or we stay paused and we risk more rollover risk with the government the way that it's, borrowing crazy amounts of money right now. So it's continuously deciding between those two things, which gives us this no landing stop go cycle. So yeah. Good question, though. Good question. What about the AI bubble? Wasn't that showing signs of a crash? No, it never did, because you saw credit spreads remaining lower, and you had a large decline in volatility. So yeah, I mean, for all the people that were calling for the bubble crash, it was just narratives. IBB continues to be bullish. Can you show the ranges? Sure. There's the ranges for IBB. I see that XLV has touched the bottom of your range from last week. Is this still a buy? And given that you're raising cash now, what percentage of your portfolio would you give to these sorts of defensive stocks? Well, I can't disclose the percentage of portfolio on this live stream. That's mainly meant for our people in our community there. But in terms of XLV reaching the low end of the trading range, yes, it did reach the low end of the trading range on lower volume there, so it is technically a buy, which I was buying a little bit, But I wasn't going crazy with it only because we are starting to see more of a large shift over to more of a recovery type of environment, which typically, healthcare could still perform okay in that environment, but really it doesn't do the best there, right? Healthcare does a really good job when you have a disinflationary type of environment and either slowing or stagnant growth, which is why it's been doing so well over the past few months. But now it's starting to have a little bit of a correction. Hasn't broken its bullish trend at all. Still remains in a very clear bullish trend. But it's something where when you're doing a buy like this and you're seeing all these other indicators shift over, then you just don't want to be as aggressive. Appreciate the likes and the shares. Any thoughts on NVIDIA selling H200 to China? I don't have any thoughts on that, really. That's kind of a micro thing. It's kind of a narrative. Anything, just a rule of thumb, anything that you see in the financial media in terms of headlines, those are all designed for the purpose of inciting a emotion out of you. Because ultimately, a lot of these things, these huge announcements and stuff like that, it may or may not be things that will help the stock fundamentally. But in this post-pandemic environment, the stock or company fundamentals, right, the valuation of things clearly isn't as important as the trend, the flows, as well as the macro environment. Because, a lot of people just a couple of years ago were saying valuations were way too high and this is not a good time to buy. Meanwhile, during that same time, the stock market had back-to-back 20+% years. And so if you were hung up on valuation, you would have missed out. And so I'm not saying valuations aren't important, but when you're solely getting hung up on that legacy playbook, then you're going to miss out on things. That's why I always say, like, if your team only valuation or your team only technical analysis and you're just going all in on that, then you're going to, you're going to give up not only gains, but you're missing out the whole picture. You need all three of them. You need to look at valuations, you need to look at the technicals, and you need to look at the macroeconomics, because all three of those will give you a more complete picture of the puzzle so that you can strategically risk manage what's happening right now in the macro environment. So I would just challenge you guys, to open up your mind a little bit, to incorporate more of these tools so that you can, do this a lot better. It's like trying to build a house with only a screwdriver, right? Don't just use one tool. You should have multiple tools in your bag. And so with that, if you guys would like to incorporate macroeconomics more in your investing process, we still have our 6-week macro mastery challenge going on right now, which if you go to the link in my bio, you can schedule a call with me if you guys would like to learn more about it. It's where you get free access to our partnership circle, which is where we include all of our weekly as well as daily updated selections, prices that we're buying things or selling things, what we're bullish on, what we're bearish on, what the research is telling us, what we're seeing in sentiment, all that stuff we cover in our community. But it's not just about reading research. We also want to show you our process, show you the language of macroeconomics. And so we have an entire 14-chapter training that you can look at and study. So if you guys are interested in that, make sure you click on the link and book a call on my calendar. We can discuss it a little bit more. But that's all I have for you guys here today. Really kind of a slow day in the news. So, with volume really coming down a lot, it's a little bit boring out there heading into the Fed meeting. I'm sure tomorrow is going to be something similar where we get another low volume day. But take these days for what they are, which are great time, which is a great time to raise some cash ahead of these big events. And then, that way, no matter what happens, you have some cash in order to either re-enter or to buy a dip on. But that's all I have for you guys here today. Thank you for joining. Good luck out there, and we will catch you in tomorrow's daily macro update. Bye, everyone.